Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 12 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topics. First, green initiatives in banking sector. Second, digital KYC and its importance. Green initiatives in banking sector. Environmental sustainability has become a global priority due to climate change, resource depletion, and rising environmental risks. The banking sector, though not a direct polluter like manufacturing industries, plays a crucial indirect role by financing economic activities that impact the environment. Recognizing this responsibility, banks across the world, including in India, have adopted green initiatives such as paperless banking, green financing, and ESG environmental, social, and governance investments. These initiatives aim to reduce carbon footprints, promote sustainable businesses, and align financial growth with environmental responsibility. While green banking offers long term benefits for society and the economy, it also presents operational, financial, and implementation challenges for banks. Therefore, a balanced analysis of green initiatives in the banking sector is essential. Positive aspects and pros and arguments in favor of green initiatives. One of the most visible green initiatives in banking is paperless banking. Digital account opening, e-statements, online loan applications, mobile banking, and digital payments significantly reduce paper consumption. This helps conserve trees, lower carbon emissions associated with printing and logistics, and reduce operational costs over time. For banks, digital processes improve efficiency, speed, and customer convenience while supporting environmental goals. Green loans and sustainable financing represent another major contribution. Banks now provide concessional loans for renewable energy projects, electric vehicles, energy efficient homes, solar panels, water conservation systems, and green buildings. By directing funds towards environmentally responsible products, banks act as catalysts for sustainable development and create climate resilience. These initiatives help reduce dependence on fossil fuels and encourage innovation in clean technologies. ESG investments have emerged as a strategic focus for banks. By integrating environmental, social, and governance criteria into lending and investment decisions, banks promote ethical business practices. Companies that comply with ESG norms are generally more transparent, socially responsible, and environmentally conscious, reducing long term financial and reputational risks for banks. ESG aligned portfolios also attract global investors who prioritize sustainability. Green initiatives also enhance brand reputation and customer trust. Environmentally conscious customers increasingly prefer banks that demonstrate social responsibility. Green banking helps institutions differentiate themselves in a competitive market, strengthen customer loyalty, and build long term relationships. From a risk management perspective, a green banking reduces climate related financial risks. Climate change can disrupt industries, infrastructure, and supply chains, leading to loan defaults. By supporting sustainable products and avoiding environmentally harmful activities, banks protect their asset quality and ensure long term stability. Negatives, cons, and arguments against green initiatives. Despite the benefits, green initiatives pose several challenges for banks. One major concern is the high initial cost of implementation. Transitioning to paperless banking requires significant investment in IT infrastructure, cybersecurity systems, staff training, and digital platforms. For smaller banks and rural branches, these costs can strain financial resources. Another challenge is limited awareness and accessibility, especially in rural and semi urban areas. Many customers still rely on physical documents and branch based services due to low digital literacy or limited internet access. This digital divide reduces the effectiveness of paperless banking and may exclude certain customer segments. Green loans involve high risk perception. Many green technologies are relatively new and their long term viability may be uncertain. Banks may hesitate to finance such projects due to lack of historical data, technical expertise, or standardized evaluation frameworks. This can slow the pace of green financing. ESG investments face challenges of standardization and greenwashing. There is no universally accepted ESG framework, making it difficult to assess the true sustainability of projects or green companies. Some organizations may falsely claim to be green to attract funding, exposing banks to reputational and regulatory risks. Additionally, green initiatives may affect short term profitability. Concessional green loans and higher compliance costs may reduce margins. Banks focused on quarterly results may be reluctant to prioritize long term sustainability over immediate returns. Balanced comparison. Green initiatives in banking represent a shift from profit only models to purpose driven finance. On one side, paperless banking improves efficiency, reduces environmental impact, and enhances customer experience. Green loans and ESG investments channel funds towards sustainable development, reduce climate risk, and align banks with global sustainability goals. On the other side, implementation challenges such as high costs, technological barriers, limited customer awareness, and regulatory uncertainty cannot be ignored. Green financing may initially appear less profitable, and ESG assessments may lack uniformity. Banks must also balance sustainability objectives with financial inclusion, ensuring that green initiatives do not exclude digitally or economically disadvantaged customers. A balanced approach suggests that green banking should be gradual, inclusive, and technology driven. Banks must combine digital innovation with customer education, robust risk management assessment, and policy support. Over time, as technology matures and awareness increases, green initiatives can become both economically viable and environmentally impactful. Arguments for green initiatives in banking reduces environmental footprint through paperless operations, promotes renewable energy and sustainable development, enhances long term financial stability and risk management, improves brand reputation and customer trust, aligns banking operations with global ESG standards, attracts responsible investors and international funding, encourages innovation in green technologies. Arguments against or challenges high initial cost of digital and green infrastructure, limited digital literacy and access in rural areas, uncertainty and risk in financing green projects, lack of standardized ESG frameworks, risk of greenwashing and reputational damage, potential short term impact on profitability. Conclusion. Green initiatives in the banking sector are no longer optional. They are a strategic necessity in an era of climate change and sustainable development. Through paperless banking, green loans, and ESG investments, banks can significantly reduce environmental impact, support clean technologies, and promote responsible business practices. These initiatives not only benefit the environment but also enhance long term financial stability, customer trust, and regulatory compliance. However, the transition to green banking is not without challenges. High implementation costs, technological gaps, limited awareness, and ESG standardization issues require careful planning and execution. Banks must adopt a balanced and inclusive approach, combining innovation with education and risk management. In the long run, green banking represents a win win model. While short term challenges exist, the long term benefits, resilient financial systems, sustainable economic growth, and environmental protection far outweigh the costs. By embracing green initiatives, banks can play a transformative role in building a sustainable future while ensuring their own relevance and stability in a rapidly changing world. Digital KYC and its importance. Know your customer KYC is a fundamental regulatory requirement for banks and financial institutions to verify the identity of customers and prevent misuse of the financial system. Traditionally, KYC involved physical documents, in person verification, and time consuming manual processes. With the rapid growth of digital banking, fintech innovation, and increasing customer expectations, digital KYC has emerged as a transformative solution. Digital KYC technology such as Aadhaar based authentication, biometric verification, video KYC, and online document submission to onboard customers efficiently and securely. Digital KYC plays a crucial role in fraud prevention, faster customer onboarding, operational efficiency, and financial inclusion. However, concerns related to data privacy, cybersecurity risks, digital exclusion, and regulatory compliance continue to pose challenges. Therefore, digital KYC is both an opportunity and a responsibility for the banking sector. Positive aspects, pros, and arguments in favor of digital KYC. One of the most significant advantages of digital KYC is speed and convenience. Customers can open bank accounts, apply for loans, or access financial products without visiting a branch. This drastically reduces onboarding time from days to minutes, enhancing customer experience and satisfaction. Digital KYC also improves operational efficiency for banks. Automation reduces paperwork, manual errors, and administrative workload. Banks save costs related to document storage, physical verification, and manpower. Faster onboarding enables banks to scale their customer base efficiently, especially in high volume retail segments. Another major benefit is enhanced fraud prevention. Digital KYC systems use biometric authentication, real time validation, AI based fraud detection, and centralized databases to identify fake or duplicate identities. Video KYC adds an additional layer of security by enabling live interaction and facial recognition, reducing identity theft and impersonation. Digital KYC significantly supports financial inclusion. Promote onboarding allows people in rural and semi-urban and in underserved areas to access banking services without traveling long distances. This aligns with national objectives of inclusive growth and digital empowerment. From regulatory perspective, digital KYC improves compliance and transparency. Digitally stored records enable easier audits, monitoring, and reporting to regulators. Banks can track customer data more accurately, ensuring adherence to anti-money laundering and counter-terrorism financing norms. Digital KYC also supports digital transformation in banking. It complements mobile banking, UPI, digital wallets, and fintech partnerships. A seamless onboarding process encourages customers to adopt digital channels, reducing dependency on branches. Negative aspects, cons, and arguments against digital KYC. Despite its advantages, digital KYC faces several challenges. One major concern is data privacy and security. Digital KYC involves collective sensitive personal and biometric data. Any breach, misuse, or unauthorized access can lead to identity theft, financial fraud, and loss of customer trust. Another significant issue is the digital divide. Many individuals, especially elderly people, low income groups, and those in remote areas, lack smartphones, internet access, or digital literacy. For such customers, digital KYC can become a barrier rather than an enabler. Technical failures and system downtime also pose risks. Network issues, biometric mismatches, or system errors can delay onboarding and frustrate customers. Inaccurate data capture may lead to rejection or duplication of records. Digital KYC can also increase dependency on technology and third party vendors. Banks often rely on fintech partners, cloud services, and external APIs. Any failure or compromise at these levels can disrupt operations and expose banks to reputational and regulatory risks. From a compliance standpoint, frequent challenges in regulations related to data protection, Aadhaar usage, and KYC norms create uncertainty. Banks must continuously update systems and processes, increasing operational complexity and cost. There is also the risk of exclusion due to strict digital checks. Genuine customers may be denied services due to minor discrepancies in documents, biometric failures, or technical errors, leading to dissatisfaction and loss of trust. Balanced comparison. Digital KYC represents a paradigm shift in customer onboarding and compliance. On the positive side, it enables faster onboarding, reduces operational costs, improves fraud detection, and enhances customer convenience. It supports digital banking and aligns with the government's vision of a digital economy and financial inclusion. On the negative side, concerns related to data privacy, cybersecurity threats, technological dependency, and digital exclusion cannot be ignored. Over reliance on digital systems may marginalize certain customer segments and expose banks to systemic risks if safeguards are weak. A balanced approach suggests that digital KYC should complement, not completely replace, traditional KYC. Banks must offer a hybrid model where customers can choose digital or assisted KYC based on their comfort level. Strong service cybersecurity frameworks, data encryption, consent-based consent-based data usage, and regulatory compliance are essential to mitigate risks. Arguments for digital KYC: faster and seamless customer onboarding, reduced paperwork and operational costs, improved fraud detection and identity verification, better regulatory compliance and audit trails, supports financial inclusion and remote access, encourages digital banking adoption, scalable and efficient for mass onboarding. Arguments against and challenges: data privacy and cybersecurity risks, digital exclusion of vulnerable groups, dependency on technology and third party systems, risk of technical failures and errors, regulatory uncertainty and compliance burden, potential customer dissatisfaction due to rejections. Conclusion: digital KYC has emerged as a cornerstone of modern banking, redefining how customers are onboarded and how compliance is managed. Its benefit It benefits in terms of efficiency, fraud prevention, customer convenience, and financial inclusion are substantial. In a fast-paced digital economy, banks cannot afford slow, paper-based processes, making digital KYC an operational necessity rather than a choice. However, the success of digital KYC depends on responsible implementation. Banks must prioritize data security, customer privacy, digital literacy, and inclusiveness. A one size fits all approach may not work in a diverse country like India. Therefore, a hybrid and customer centric model supported by strong regulatory oversight and technological safeguards is essential. In conclusion, digital KYC is a powerful enabler of secure, efficient, and inclusive banking. When implemented with caution, transparency, and empathy, it strengthens trust between banks and customers while safeguarding the financial system. Thus, digital KYC is not merely a technological upgrade, it is a strategic pillar for the future of banking. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.